Right now, as I record this, there is a rule sitting in the federal tax code with your name on it, if you are 65 or older, worth up to $6,000 a year off your taxable income. $12,000 for a married couple where both of you qualify. It became law in the summer of 2025, buried inside a bill several thousand pages long. And here is the part I need you to hear in the first minute of this video. It has an expiration date. This rule is scheduled to disappear after the 2028 tax year, which means this is not one of those benefits you can get around to eventually. There are only a handful of tax returns between now and the day this door closes, and every single one you file without knowing about it is money, your money, gone for good. The IRS will not send you a letter about it. Your pension office will not mention it. And by the time it makes the evening news, the window will be half over. So today, I'm going to walk you through it plainly, the way I wish somebody had explained things across a desk my whole career. My name is Harold Briggs. I spent 43 years inside the same small-town bank in Ohio, teller to branch manager. And I want to tell you why this particular topic gets me going. In 43 years, I never once, not one single time, met a government benefit that walked in the door by itself. Every exemption, every deduction, every program I ever watched put money back in a customer's pocket had to be found, understood, and claimed by somebody who knew it existed. The rules are written down, in public, for anyone. And still, year after year, the people who needed them most were the last to hear about them. That's not an accident, friends. That's just how paper works. Paper doesn't knock on doors, so consider this video me knocking. Here's the plan for the next 20 minutes. I'm going to tell you exactly what this new deduction is and how it works. Then I'm going to show you the stacking arithmetic. Because this thing does not stand alone, it piles on top of deductions you already have. And when you stack them properly, an ordinary retired couple can shield a genuinely startling amount of income from federal tax. For some of you, all of it. Then who qualifies and who gets phased out? The three traps that will quietly cost people this money, and exactly what to do about it before your next return. And the stacking math is the part most people have never seen laid out, so I am not going to make you wait for it. Stay with me. But first, the two thoughts I can hear forming. Thought 1. Harold, my income's too small for tax tricks. This is for people with money. Friend, turn that around. If your income is modest, this deduction may not just lower your tax. Combined with the other deductions you already get, it may erase it entirely, and it may mean money should stop coming out of your pension check every month starting now. Small incomes have the most to gain here, percentage-wise, of anybody. And thought 2, the opposite. We do fine, we itemize, we have an accountant, surely this is handled. Maybe, but this particular deduction has an unusual feature. It works whether you itemize or not, which confuses people, including, I am sorry to say, some paid preparers in year 1 of any new rule, and it phases out at higher incomes, which means for some of you the question isn't whether you qualify, it's how to arrange the next few years so you keep qualifying. Either way, you need to know how it works. Both groups, stay put. I've seen this movie before, by the way, and I want to tell you how it goes, because it's the reason I'm making this video early in the window instead of late. The last time the deduction rules changed this much, years back, I was still behind the desk, and I watched the pattern up close. Year 1, almost nobody had heard of it, and the ones who had didn't trust it, because if it were real, surely somebody official would have told them. Year 2, the sharp ones had it, the folks with the good accountants, the ones who read the financial pages, money flowing back into exactly the households that needed it least urgently. Year 3, it finally hit the church bulletins and the barbershop conversations, and my lobby filled up with people asking, Harold, is this true? And could I have had this last year too? And some could have, and some of those never got it back, because the clock on amending only reaches back so far. The information always arrives, friends. It just arrives in order of who's paying attention, and the bill for arriving late is paid by the people at the back of the line. Today, you're at the front. That's the entire service I'm performing here. And here is the one idea to carry through everything today. A deduction is not a discount the government hands you. It is a claim you file. The law creates the right. The return collects it. And between the right and the collecting there is a gap, and that gap is where this money will be lost by millions of people, quietly, over the next few years. Being eligible and being paid are two different things. The law does not fill in your tax return. You do. So, part 1. What this thing actually is. In July of 2025, a large tax law was signed, and tucked inside it was a brand new deduction sometimes called the senior bonus deduction. Here is the plain English version. If you are 65 or older by the end of the tax year, you can subtract up to $6,000 from your taxable income per qualifying person. Married, filing jointly, both 65 or over, up to $12,000. It applies for tax years 2025 through 2028, 4 returns, and then, unless Washington acts again, it's gone. And the feature that makes it unusual, the one I mentioned. Most extra tax breaks force a choice. Take the standard deduction or itemize your deductions. Pick a lane. This one doesn't care. It sits on top of whichever lane you're in. Retiree with big medical bills who itemizes? You get it. Retiree who takes the simple standard deduction like most folks do? You get it too. That on top of everything quality is exactly what makes the stacking arithmetic so powerful, and that's part 2. Part 2, the stack. The part I promised. Follow me through this slowly, because when I show people this on paper, this is the moment their eyebrows go up. Start with the standard deduction, the basic amount every filer gets to subtract before tax is even calculated. For a married couple, that's already north of $30,000 as I record this. On top of that, there has been for years an extra additional deduction just for being 65 or older, a smaller amount per person that many people don't even realize they're getting. And now, on top of both of those, comes the new bonus, $6,000 per qualifying spouse, $12,000 for the pair of you. Stack all 3 layers, and a married couple, both over 65, taking no exotic steps whatsoever, no accountant tricks, no itemizing, can shield somewhere in the neighborhood of $46,000, $47,000 of income from federal income tax. Single filer over 65, roughly $23,000 and change. Now hold that number up against a typical retirement income. Social Security, which for many people is already partly or fully untaxed. A modest pension. Some withdrawals from the retirement account. Friends, for a very large share of American retirees, that stack covers most of the income there is. And for a good many of you watching, it covers all of it. Which means your federal income tax bill for these 4 years may be small or may be zero, legitimately, legally, by the plain letter of the law. The exact figures shift a little each year with inflation, so don't carve my numbers in stone, but the shape of the stack is the point. 3 layers. Most people only know about the first one. Your eyebrows just went up the way my customers always did. Take 1 second and hit the like button, because it pushes this video to the next retiree who's never seen the stack laid out, and there are millions of them. And subscribe, because I make one of these every single day. All right, part 3. Who qualifies and who gets trimmed? The age test is simple. 65 by the end of the tax year, per person, no exceptions for close. The income test is where you need to pay attention. This bonus deduction phases out as income rises. Once your modified adjusted gross income, that's your income for tax purposes, with a few things added back, crosses a threshold, roughly $75,000 for a single filer, roughly $150,000 for a couple as I record this. The $6,000 starts to shrink, and somewhere well above those lines it disappears entirely. Now 2 things about that. First, if you're under those lines, and most retired households are, you get the whole thing, full stop, breathe easy. And second, if you're near the line, listen closely, because this is where knowing beats guessing. A lot of retirees have more control over their yearly income than they realize. The size of the withdrawal you take from the retirement account, which account you take it from, when you realize a gain, whether that big one-time thing happens in December or January. People near the threshold can, with legitimate ordinary planning, keep themselves qualified for this deduction across the window. And people who don't know the threshold exists can accidentally poke 1 year's income over the line and hand the benefit back. Let me sketch what that looks like without crossing into advice, just so you can recognize the shape of it. Picture a single retiree at $72,000 of income who's been thinking about taking an extra $10,000 out of the retirement account this year for a new roof. Taken all in 1 year, that withdrawal shoves her past the threshold and starts shaving her bonus deduction, so the roof quietly costs more than the roofer's invoice says. Taken as $5,000 in December and $5,000 in January, 2 tax years, she may stay under the line both years and keep every dollar of the deduction twice. Same roof, same money, different calendar, different tax. That is the entire universe of what near-the-line planning means. timing and sequencing things you were going to do anyway. And it is precisely the conversation to have with a qualified preparer or a fee-only advisor before you move money, not after. This 4-year window is exactly the moment such a conversation pays for itself. What I'm telling you is the threshold exists, now you know. Near the line, plan the line. Part 4. The 3 traps. Trap 1, and it's the biggest, the myth. You may have heard it said loudly that this law ended taxes on Social Security. Friends, I want to be precise, because myths cost money in both directions. This deduction does not specifically eliminate the tax on Social Security benefits. The rules for how much of your Social Security counts as taxable income did not change. What happened instead is what I just showed you. The deduction stack got taller. And for many people, the stack is now tall enough that little or none of their income, including the taxable slice of their Social Security, actually ends up taxed. Same destination for a lot of households, entirely different road. Why does the difference matter? Because people who believe the myth do trap number 2. They stop filing, or they never start. Somebody hears taxes are over for seniors, so they skip the return entirely, and in doing so, they claim nothing. And if any tax was withheld from their pension or their Social Security during the year, it sits with the IRS, unclaimed, because a refund needs a return the way a claim needs a form. Hear me on this. This deduction lowers what you owe. It does not fill out paperwork for you. For these 4 years, filing is not a burden, friends. Filing is the collection mechanism. Even if your tax comes out to 0, especially if it comes out to 0 and money was withheld all year. And that's trap 3, the withholding trap, the one regular viewers will recognize, because it's the quiet one. If this new deduction drops your actual tax to little or nothing, but your pension and your accounts keep withholding at the old rate, month after month, then you are making an interest-free loan to the government all year and collecting it back maybe the following spring. On a fixed income, that's your grocery money riding around in somebody else's account. Once you've seen where your tax actually lands under the new stack, check your withholding and size it to reality. Part 5. How to actually collect. This is your week, and it's short. First, dig out last year's return, or this year's if you filed, and look at one thing. Was the senior bonus claimed? If you use a preparer, this is one direct question on the phone. Did you apply the new senior bonus deduction on my return? And did I get the full amount? Make them answer in a sentence. If you did it yourself with software, the good programs handle it, but year 1 rules get missed, so verify. Second, if the answer is no, or nobody's sure, returns can be amended, friends. If you qualified and it wasn't claimed, that money is recoverable, and asking about an amendment costs nothing. Third, if numbers and forms make your shoulders tense, hear this clearly. You do not have to pay anyone. The AARP Tax Aid Program and the IRS's own tax counseling for the elderly put trained volunteers across this country, free, specifically for seniors, and this exact deduction is now their bread and butter. One appointment before your next return. And fourth, the calendar. This rule runs through 2028 as things stand. Put a note wherever you keep your important papers. Every year of the window, the question gets asked, was the senior bonus claimed? 4 returns. That's the whole campaign. Now, one more thing before I make this real, and I include it because the source of every silver lining is a cloud, and this cloud is already formed. Whenever a new benefit for seniors makes the rounds, the scammers arrive before the paperwork does. It is as reliable as geese in October. So let me arm you, because the calls and the emails are already out there. Nobody from the IRS will ever call you about this deduction. Not once, not ever. The IRS initiates contact by mail, period. And no legitimate soul on this earth needs your Social Security number, your bank login, or a gift card to help you claim a deduction. There is no sign-up. There is no registration fee. There is no limited time enrollment window that some helpful stranger on the phone can secure for you today only. The deduction is claimed in exactly one place, on your tax return, by you or by a preparer you chose and walked in to see. Anyone who contacts you first about this rule, by phone, text, or email, is phishing. And the correct response is the one my mother taught me for door-to-door salesmen, which is a polite nothing followed by a closed door. And I'll tell you the one that gives every one of these operators away. Urgency plus secrecy. Act now. Don't tell your kids. Don't check with anyone. Friends, real benefits are the opposite. They sit patiently in the law, in public, for years, waiting for you to claim them, and they welcome every question you ask. Anybody rushing you is not helping you. Share that with the people you love who answer the phone too trustingly, because this audience, our generation, is exactly who those calls are dialed at. Let me make it real, the way I always do. A couple I'll call Frank and Dolores, both 68 Ohio people, the kind I banked for my whole life. His pension, her Social Security, his Social Security, a modest yearly withdrawal from the retirement account. Call it a comfortable, careful, ordinary retirement. Under the old stack, they owed a real, if modest, federal tax bill every spring, and they had withholding set up to cover it. Under the new stack, the standard deduction, 2 age 65 additions, and $12,000 of senior bonus, their taxable income all but vanishes. Their actual tax owed drops to nearly nothing for 4 straight years. But notice what has to happen for that to become real money in their pocket. Somebody has to claim the deduction on the return. Somebody has to notice the withholding is now too high and turn it down. 2 small actions, or the whole benefit stays theoretical while the same dollars flow out of their checks every month, exactly as before. That's this entire video in one household, friends. The law did its part in July of 2025. The rest, nobody does but you. And I'll add the epilogue to Frank and Dolores, because it's the part that stays with me. When a couple like them finally sees the new arithmetic on paper, tax bill near zero, withholding turned down, an extra stretch of money staying in the checking account every single month, the first reaction is never celebration. It's suspicion. Harold, this can't be right. We'll get in trouble. That instinct, friends, that flinch is what a lifetime of honest bill paying does to a person, and I respect it more than I can say. But hear me, claiming a deduction that Congress wrote, passed, and signed with people exactly like you and mine is not a loophole, not a trick, and not something to feel sheepish about. It is the system working as designed, for once, in your direction. The folks with accountants have never once flinched at claiming what the law allows. You've earned the same steadiness. Take the deduction, adjust the withholding, and spend the difference on the go years with a clear conscience, because the clearest conscience in the room should belong to the person who followed the rules for 50 years and finally got a rule written for them. And do one thing for somebody else, today if you can, because this one genuinely has a clock on it. You know somebody over 65 who files the same way they filed for 30 years and hasn't heard a word about any of this. A brother, a neighbor, the friend who still does her taxes at the kitchen table with a pencil. God bless her. Send them this video, because 4 returns is all the chances anybody gets, and one of those chances may already be behind them. Then leave me a comment. Tell me whether your preparer mentioned this deduction to you, or whether you had to find out from an old banker on the internet. And tell me what state you're in while you're down there, because state taxes are a whole separate animal, and the states you name decide what I dig into next. I read every single comment. And subscribe, because next time I'm taking on the biggest check most of you receive, Social Security itself, and the claiming mistake that quietly shrinks that check for life, that millions of people make in the first year, often in the first phone call. If you have not claimed yet, or somebody you love hasn't, that one's not optional. Everything I've shared today is general educational information, not personal tax, legal, or financial advice. Tax figures, thresholds, and rules change. They differ by household, and the numbers I've quoted are approximations as of the time I'm recording. So before you act, confirm the current year details with the IRS's published figures, a qualified tax professional, or the free senior tax services I named. That's not me covering myself. That's just sound banking. If you want more plain English help protecting the money you earned, subscribe to the channel. Look after your money. You earned it twice. Once when you worked for it, and once when you kept it. I'll see you in the next one.